Good morning, grade 12s. I'm Mrs. Wessels from Bloemfontein. Today I'm going to do another cash flow statement. It's the last one. It is with missing figures, so I think you will find it very interesting, but also very challenging. So please do your calculations with me, see what I show you, do all the tricks that I show you in previous lessons, and let's see if we can do this today. Thank you very much. I hope you enjoy it. You can see that I took it from the New Era. Thank you to New Era, the New Era textbook. It is task 3.51. It is the cash flow statement of Mega Pty Limited. Provide the missing figures denoted A to O. So you can see that there's a few things that is included there, and I also put on my answering paper the A, B, C, D, etc. There's only a few information, the rest we must do ourselves, and I'm going to go to the information because you can see there everything is on the answering sheet as well. So they gave us the taxation that was paid, they gave us the proceeds from sale of fixed assets, they gave us the repayment of the long-term loan, and then the cash and the cash equivalents beginning and end of the year. And then there in note number 1, they gave a little bit more information, but I think we must just start whatever we must do there. This is the only additional information that they gave us. So I think we are going to move there because the rest of them are on my answering paper. Okay. The long-term loan is 30,000 at the end of the current year. The 50,000 was repaid halfway through the year. Remember, there's the 50,000 that they already showed us. That was repaid halfway through the year. And the interest rate is 15% per annum. Interest is not capitalized. All interest has been paid on due date. For this information, we need to do that because we need that L, interest expense, in our cash flow statement. I'm going to do a little bit of rough quickly first, or calculations there. The long-term loan was is now 30,000, so it was 80,000. So we can say 15% of 80,000. That was for 6 months. It was for 6 months, and then it is 15% of the 30,000 for 6 months, because that was after we paid the 50,000 rand. So the calculations there gives us the 15% of the 80,000 times 6 months, and that gives us 6,000 rand there. And then 15% of 30,000 times 6 months, that gives us 2250 there. And that gives us plus the 6,000 rand, that gives us 8250. They mentioned that all interest has been paid on due date. So that means that the moment that we put in that 8250 as interest expense at the bottom, 8250 in note number 1, we can also put that in as interest paid on the top for number C, 8250, because everything was paid. So that's why we can do that. Let's do all the additional information, then we can go back and see what we need to calculate. 100,000 new shares were issued at the beginning of the accounting period at 240 cents each. That is proceeds from shares issued. It was 100,000 shares times 2 rand 40. 100,000 shares times 2 rand 40. 100,000 times 2 rand 40, and that gives us 240,000 rand. Money coming in. Okay, I just want to quickly say that with this information, 1, 2, 3, 4, 5, 6, a little bit of information, a cash flow statement, it seems that it's going to only take us a few minutes, but I promise you we are going to do a little bit of calculations for this cash flow statement. Okay, there are 250 shares in issue at the end of the accounting period. You maybe think, why do we need that? We need that for our dividends when we come to information number 6. Okay, we can quickly finish off this one. 240 minus the 50,000 that we pay back on the loan, and that gives us 190,000 there. 190,000 there. The taxation rate is 30% of the net profit. SARS was owed 4,100 at the beginning of the counting period and 3,000 at the end. Remember that the tax was given to us. The tax was given to us. That tax consists of a bracket. That bracket say that we owe SARS at the beginning of the year 4,100. Remember, we pay that 4,100. We owe them 3,000 at the end of the year, and that we didn't pay. Can you see there? So now we must calculate the tax amount, the tax assessment that is at the beginning of the year. SARS is a creditor because we owe them. At the end of the year, SARS is a creditor, and in the middle is our tax assessment, and that is what we must calculate now, so that our end answer is 28850 in brackets. So I'm going to make the 28850, and then I'm going to add the 3,000 and minus the 4,100. That gives me, oh no, this is not correct, so I'm going to try again. 28850 plus the 3,000 minus the 4,100, that gives me 27750, but always check. Always check. Remember, that is a minus. That is a minus because your tax assessment is also always a minus. Just check. So now we say, in the bracket, we've got a positive 3,000 Rand. That is what we owe SARS at the end of the year, and we didn't pay them. We minus the 27750, that was the tax assessment, and we paid that 4,100 that we owe from last year, and that gives us 28850. So there we've got the tax assessment. That tax assessment equals to 30% of the net profit. So now that we've got the tax assessment, we must work with that amount there, or that calculation there. So we must now calculate 30% of X, and X is the profit before tax, gives you 27750. X equals to 27750 times 100 divided by 30. So that gives you 27750. 27750 times 100 divided by 30, and that gives us 92500, and that 92500 is basically your profit before tax. Profit before tax. Okay, so that we need in note 1, profit before tax, and that is 92,500. Okay, let's start with the 92,500. We add 24080 and we add 8250, and that gives us 124,830. 124,830. That was already done for us. 17,000 plus 19,000 minus the 20,000 in brackets, and that gives us 16,000 plus the 124,830, and that gives us 140,830. 140,830. So we already solved KLMNO. That total of 140,830 goes to the top as number B. 140,830. 140,830. Fixed assets were 913,000 at the beginning of the year and 115,650 at the end of the year. Okay, this is not a lot of information, but luckily they gave us this one. Luckily they gave us that one, and also depreciation. Can you see? So they gave us that, and they also gave us depreciation. So what are we going to do? Note number 3. Remember, note number 3 is your best friend when you must calculate any missing information. You use note number 3. For fixed assets, sometimes you can open a column for vehicles and for you can open 2 separate columns for vehicles and equipment. But in this case, we only have fixed assets, so we cannot do something like that. Okay, we start with carrying value. Carrying value, beginning of the year. Then we say plus additions at cost. Then we say minus disposal at carrying value. Then we say minus depreciation. And that gives you the carrying value at the end of the year. Okay. It's a little bit rough. They mentioned that the fixed assets were 913,000 at the beginning of the year and 1,150,650 at the end of the year. We've got the depreciation. Remember, we've got the depreciation. That was 24080 that was given to us. In this case, it's a minus 080 because it makes our fixed assets, the value of our fixed assets less. And we also have the 7,200 proceeds from sale of fixed assets. 7,200, that also in brackets. And now you can calculate your missing amount. Your missing amount there. I always start at the bottom. And I say 1,150,650. And I add 24080. I will add the 7,200. And then I will minus the 913,000. And that gives me 220,770. Okay, that's not correct. Let's try again. 1,150,650 plus 24080 plus 7,200 minus 913, and that gives us 268,930. 268,930. 268,930. That was additions. But remember, in your cash flow statement, this is money out. That is money out. So there, 268,930. That is money out because that was purchase of fixed assets. Purchase of fixed assets. The fixed deposit increased with 6,000 Rand during the accounting period. That means that changes in financial assets. That means that money goes out because we put more money. We put 6,000 Rand more on a fixed deposit. So that we put there. Dividends, the final dividend for last year, the interim dividend for this year, and the final dividend for this year. If this is your shareholders for dividends, shareholders for dividends. The balance that we start there, balance brought down at the beginning of the year, is the final dividend of the previous year. Is the final dividend of the previous year. So, and remember, we have 250,000 at the end of the year, so it was minus the 100,000, so it was 150,000 at the beginning of the year. So the final dividend of the previous year equals to 12 cents, 150,000 shares times 12 cents. Okay, that gives us 150,000 times 12 cents, and that gives us 18,000 Rand. 18,000 Rand. That balance is there. What is the first thing that we do with that 18,000 Rand? We pay them. As soon as the as soon as the year start, we pay them 18,000 rand. Okay, so we basically make sure that that 18,000 rand is paid. Then the interim dividend for this year. The interim dividend for this year is 250,000. Why is it now 250,000? Because the new shares were issued at the beginning of the accounting period. So now the total is 250,000. It is 8 cents per share. That gives us 250,000 times 8 cents per share, and that gives us 20,000 rand. 20,000 rand. Where do we see the interim dividend? We don't see the interim dividend in the shareholders. We see the interim dividend in our nominal account. Remember, that is our B account. That is our shareholders that we owe money to. Okay. But in the nominal account, dividends on ordinary shares. There on the debit side is a bank CPJ. There's a bank CPJ. And that is your interim dividend. This is your interim dividend that we pay during the year. So that's where we see the 20,000. Then the final dividend for this year. The final dividend for this year, interim final dividend for this year is again 250,000 times 11 cents per share. Times 11 cents per share, and that gives us 250,000 times 11 cents per share, and that gives us 27,500. 27,500. Where do we see the final dividend? Okay, I'm going to show you again. The 18,000 was the final dividend of the previous year. That was paid. The 20,000 is our interim dividend. That was paid, but the final dividend is never paid. So shareholders for dividends will show us the 27,500 there because it's not paid. So we owe the shareholders dividends on ordinary shares. So we owe them the 27,500. That will be our balance. And then we take to the appropriation account the total of the interim dividend and the final dividend. This is our final dividend. This is our final dividend. Okay, so to the appropriation account, we will take 47,500 and 47,500, 47,500. So that is our total dividends. Okay. So that was information number 6. Now we must just take this to the, I can do the note quickly and then, no, I'm not going to do the note. Okay, let me do the note. The normal note for dividends paid looks like this. Dividends paid. You know the note, but remember they don't ask us notes anymore. We say balance at the beginning of the year. Balance at the beginning of the year was the 18,000. The question is the 18,000 paid? Is the 18,000 paid? Yes. How do I know that? There's a bank for the 18,000. So that's why you put the 18,000 in brackets. Now you say amount as per financial statements. That is the 47,500. That is the total dividend for this year. The total dividend for this year. And why do I put it in brackets? Because we were supposed to pay 47,500. But balance at the end of the year show that we didn't pay the 27,500 because that is on the credit side of shareholders for dividends. So the 27,500 was not paid. So if I do that calculation there, that is the final dividend. The final dividend is not paid. This is the final dividend of the previous year. That one is paid. The final dividend of this year is not paid. if I do this calculation and I say 27,500 minus 47,500 minus 18,000, that shows me that we paid 38,000 rand. We paid 38,000 rand. Now I'm going back to the ledger accounts to show you that is exactly what we paid if we add the two banks together. If we add the two banks together, the 18,000 and the 20,000, and that gives you 38,000 rand. So what did we pay? We pay basically another calculation to show that this is, if I ask you, what did we pay? Of all the dividends, what did we pay? We pay the final dividend of the previous year plus the interim dividend of this year. That was the 18,000 there, plus 20,000 was the interim dividend, and we paid 38,000 rand during the year. So what calculation must you do? You're more than welcome to do that calculation. You're more than welcome to do this calculation, because both of them are supposed to be on the memo. So for the dividends paid there, for the dividends paid in our cash flow statement, I know the answer is 38,000 rand. We know the answer is 38,000 rand, and that I will say is minus the 18,000 at the beginning of the year, minus the 47,500, the total dividends for this year, plus the 27,500 that we didn't pay yet. There's your accounts. I start with the 18,000 in brackets because we paid it. Then I put the 47,000 in brackets because that was what we're supposed to pay. And then I show the 27,500 as positive. Okay, now we can just finish off. And we can say 140,830 there, minus 8250, minus 38,000, minus 28850. That gives us 65730. 65730. In the middle, we've got a positive 7,200 rand, minus 6,000 rand, minus 268,930. 268,930, and that gives us 267,730 in brackets. 267,730 in brackets. The lower part is 190,000. If we go back there, if we go back to the cash and cash equivalents, we will say that 58,000 minus 46,000 means that there was 12,000 rand during the year that was paid out in total for that 58 to become 46. Let's check from the top. We are going to take A, E, and H. 65730 minus 267,730 plus 190,000 rand, and that gives us 12,000 rand in brackets, and we know that our cash flow statement is 100% correct. This was only a cash flow statement with missing figures that I just want to show you. Although it's a little bit of information, we must still do a few calculations. Okay, this was the last on cash flow statements. The next question that I've got here is only a small analysis and interpretation. I just want to show you a little bit of this, only the major things that they normally ask us in the question papers for analysis and interpretation. Okay, the first thing for this, you must know your formats. You must know your old formats from grade 11. You must know the new ones. There's only a few new ones. Earnings per share, dividends per share, net asset value. I'm only going to say a few things on each of them, and then we are going to do a few calculations. Okay, there's basically three new calculations in grade 12. The first one is there are four of them, and the other one is the net asset value. I'm going to quickly run through those three, and then those four, and then we can also go there. If they ask you, remember this is given. There is one that we must calculate, but I just want to go through all of them quickly. That is our new formulas. Remember, you must know your formulas. Okay, I think that is not correctly spelled. Percentage return on total capital employed. Percentage return on total capital employed. Okay. That is one that they didn't often ask you to calculate, but they want you to use it. But if they ask you to calculate it, it is net profit before tax in your income statement. Remember, you come from the top in your income statement, then you say operating profit, interest income, net profit after, before interest expense, net profit before tax, and then you add the interest expense. And then you divided it by average capital employed. And you will remember that I did a balance sheet where they also mentioned this capital employed. The capital employed equals to your shareholders' equity plus the loan. So if I look at the information that I've got here on page 2, if I ask you to calculate, I don't think I've got the net profit before tax. Let me quickly see. I've got net profit after tax. Okay, that's easy. So if we must calculate it, if in this case we must calculate it, just do the calculation. I don't know if the answer will be exactly what it is there. Let me take that out. Let me take that 1 million there out. Okay. Let's see what we've got. I remember they gave it to us. We're not supposed to calculate it, but I want to calculate it. So if the answer is not the same, don't worry about that. Okay, net profit after tax, 3250800. 32500. We don't have the interest expense. I think I've got it here. I just didn't add it there. Okay, let me quickly add it. I'm sorry. I just want to add it. I didn't think that we are going to do it, but let's do it. Interest expense, and that was 45,000 there. Oh, let's quickly put it in there. 45,000 in there. Okay, let's take out that space there. So there it is. Okay, so I'm going to use the 3250800, the net profit after tax. Then we add the tax of 1,393,200, and then we add the 45,000. Okay, that is information that I got there, so there you can see it. I took the net profit after tax, net profit after tax, net profit after tax. I add the tax because I need net profit before tax, and I add the interest expense. I add the interest expense, and that we are going to divide between half of. Now we say shareholders' equity plus the loan. Shareholders' equity plus the loan. That gives you last year 19370,000 plus the 2,400,000 for last year's loan plus 255,20800 plus 800,000 for this year's loan. Okay, so that gives us, this is a big calculation, 255,800 plus the 1,393,200. I must just make sure that I do the correct calculations. Let me start over. 3,250,800 plus 1,393,200 plus the 45,000. That gives us 4689. 4689000 divided by 1937000 plus the 2,400,000. The 2,400,000 plus the 25520,800. 25520,800 plus the 800,000 that we've got for the loan divided by 2. That gives us 24045. 24045. 24045. 400 times 100 over 1, and that gives us 4689000 divided by 24045 400 times 100, and that gives us 19. Okay. Oh, that was last year. That was 2016. But why do we have 2016's answer now? That is not supposed to be put to look like that. We don't have the 24,5, but we've got the 19,5. Okay, so this is wrong. Maybe it must be the other way around, but we've got 19,5%. But the big thing is that I just want you to calculate. Let's turn it around there so that we can say there 24,3, 24,3%. 24,3%. Sorry, 23,4. Oh, I must concentrate. 23,4% on that side, and we put the 19,5 on this side because that is what we just calculated. 19,5% on this side. Okay, just to show you how to calculate it. But most of the time, they don't ask us to calculate that. Okay, that was only because I know that is the one that most of the learners struggle a little bit with. Okay. The next new calculation in grade 12 is your return on shareholders' equity. That was basically a question that they asked us to do. So the first one that they ask us to do is to calculate the debt equity ratio. There on top, 4.6.1 or 4.6, the debt equity ratio, the net asset value per share, and the return on shareholders' equity. And after that, I will just show the earnings per share and the dividends per share. But I'm not going to do the calculation because maybe that will also not be correct. Okay. For your debt equity ratio, you say it equals to non-current liabilities. To remember, it's not necessary to write it down. I just prefer to write it down to your shareholders' equity. And we're going to calculate it for this year. We're going to calculate it for, February 2017. So we do the calculation for this year. So the non-current liabilities is your loan of 800,000. Your shareholders' equity is 25520,800. And I will promise you this will be a very, very good debt equity ratio because can you see how small is our loan? What are we busy calculating? Foreign capital to own capital. That is what we're busy calculating there. So the lower, the better. This one is the lower, the better. This is the one that you want to be as low as possible, and this one is going to be very, very low. So we put the 800,000 in there, 800,000 divided by 25520,800, and that gives us a 0,03 to 1. 0,03 to 1, meaning that for every 1 rand own capital, we only owe 3 cents to the loan there. Net asset value per share. What is the meaning of that word? What is the meaning of the net asset value per share? The value of shares on paper on a specific day. Okay, meaning on the last day of the year, we are on the last day of the year, we are on the 29th of February 2017, and we just calculate what is the net asset value today. Okay, so we say for net asset value, we say net profit shareholders equity divided by number of shares issued times 100 over 1, but it's not a percentage. The answer is in cents. So your shareholders equity is 255,20800 divided by, and they mentioned somewhere there, 3,800,000 ordinary shares were issued at the end of the financial year. So we put the 3,800,000 shares there. We say times 100 over 1, and that gives us 255,20800 divided by 3,800,000 shares times 100. That gives us 671.6 cents. 671.6 cents per share. Okay, now they can ask you more questions on this. They didn't do it, but they can ask you to compare that net asset value with your market price. For example, this market price. And then they can ask you, how did it compare? So what is the difference between the two? Let me just put it clear. The net asset value, like I said, is the value on paper. The market value that they gave us there equals the value on the JSE. How is the value on the JSE? Who decide on the value there? Demand and supply. So people outside that wants to buy our shares, if there's a big demand, the price will go up. Okay, so the 750 cents there, we've got 671.6 cents, and we've got 750 there. So at the moment, okay, can you see that the market value is more than the net asset value? So it means that our company is very popular at the moment. There's only good things about us on the radio and the TV, because everybody wants, because the market price, the JSE, the people outside are willing to pay more. They're willing to pay 750 cents for shares that's only worth of that. If you think about Steinhoff last year, where everything, Steinhoff goes down and the price of the shares drop drastically, and then it's not the case at the moment for this company. So now they can ask you a few questions on this. For example, they can ask you, will you buy a share at the moment? Will you buy a share at the moment for 750 cents? Then you will say no, because it's more than what it's worth. Will you sell shares for 750 cents? Then you will say yes, because you can. The market price is more than that. So just bear that in mind. They can ask you a few questions on that, where you compare the market price and the net asset value. The next question was the return on shareholders' equity. The return on shareholders' equity gives you the net profit after tax. Net profit after tax. Net profit after tax divided by average shareholders' equity times 100 over 1. So that gives us the net profit after tax. Sorry, I just want to quickly go back there. It was 3250,800. 3250,800 there. The average owner's equity is half of the 25,520,800 plus the 19,370,000. That gives us 3250,800. Sorry, my answering paper is a little bit small, so I'm quickly going to do the calculation there. 255,20,800 plus the 19,370,000 divided by 2. That gives us 22,445. 22,445,400 times 100 over 1, because the answer is a percentage. That gives us 3250,800 divided by 22,445,400 times 100 over 1. That gives us 14.5%. 14.5%. The question that they ask on this one is question 4.9. 4.9. Explain why the shareholders should be satisfied with the return on their investments. The return on their investments, quote financial figures. I will just say that I will not be very happy if I'm a shareholder, because this 14.5% and the 13.2% last year, 13.2% last year in 2016, and 14.5% in 2017 is not a very high percentage. If you compare it to alternative investments, remember that is your interest rate at the bank, interest rate on investments in the bank. Investments in the bank, then I will not say that it is so high, because that we always say between 7 and 11%. But that's not the question. Most of the time we compare it to the alternative investments, the 7 and the 11%, but not in this case. They say explain why the shareholders should be satisfied. So you must look for other things that make them that they are satisfied. We can say that the return on shareholders' equity, remember that is the that you can write there, increased from 13.2% to 14.5%. So there is a little bit of an increase. So that is positive. You can also say that the earnings per share increased from 80 cents to 95 cents. There you've got the earnings per share there. From 80 to 95, earnings per share increased from 80 cents per share to 95 cents per share. So in this case, you were forced to give a positive thing there. So you cannot, in this case, don't compare it with the investments, because that was not the question. They say that they are satisfied. You must just quote figures why they are satisfied. They also mentioned dividends per share decreased from 96 to 90 cents. Dividends per share, remember DPS, earnings per share EPS. Dividends per share decreased from 96 cents per share to 90 cents per share. Okay, why is this positive for the business, for the company? That shows that there will be more money. They will retain more money. Retain money for future improvements or whatsoever. So that was the analysis of the return on average shareholders' equity. Question 4.7 is very important. They love to ask this nowadays. Please make sure that you understand it. Please make sure that you can do it, and it's very, very easy. They talk about the dividend payout policy. Dividend payout policy. Okay, it's very easy to do it. Provide calculation to show the change in the dividend payout policy and comment on its impact on retained earnings. For this, you put the DPS on the EPS. Okay. To remember that, it means that you must first earn some money before you can pay out dividends. Remember, I'm talking about earnings per share and I'm talking about dividends per share. I didn't put it in there, but I can quickly put it in there. This is EPS. That one is EPS. We talk about EPS. You're more than welcome to, in your question paper, to write the EPS, because that you can say, and this one is DPS. DPS, dividends per share, earnings per share. So you must first earn money before you can pay out dividends. Just remember it as that. You first earn money so that you can pay it out. For 2016, for last year, you put the 96 on the 80 cents. Can you see that? Your dividends was 96. On the 80 was the earnings, times 100 over 1, because we need a percentage there, and that gives you 96 divided by 80, and that gives you 120%. 120%. In 2017, it is the 90 over the 95 times 100 over 1, and that gives us 90 divided by 95 times 100 over 1, that gives us 94.7%. 94.7%. Okay. Comment on this. The comment that we are going to say on this is that in 2016, 20% extra must came from the retained income. So in this case, we pay out 100% of our earnings to the shareholders. We pay out 100% of our earnings to the shareholders, and the other 20% must come from retained income. So we paid out all our earnings, the whole 80 cents, and another 20% from retained income. So in this case, there's nothing left. We need to borrow. We need to borrow that 20% from the retained income, because our earnings was not enough for our dividends. In 2017, we pay out 94.7% of our earnings per share to our shareholders, and retain. Retain means that we hold back. Then you just say 100% minus 94.7, so that gives us a 5.3%. We retain or kept we retain or hold back 5.3% in the company. This is they love to ask this question. So please make sure that you understand what you must do. You put the DPS on the EPS. That is the first thing that you do. Then you times it by 100 to get a percentage. And then you just say something about it. Last year it was 120%, meaning that we pay out our whole earnings per share to our shareholders, and the other 20% must came from the retained income. Please don't say that no money is retained or something like that. Just say something like this. And then for this year, we only pay out 94.7% of our earnings to our shareholders and retain or hold back 5.3% for the future or for future use or whatsoever. The last question that I've got here is to do with the, they ask us, we want to expand and they additional loan. If they ask you anything on taking out another loan and they ask you two financial indicators, please use your debt equity ratio. Debt equity ratio is the first one. The debt equity ratio, okay, not equals. Last year it was 0.12, decreased from 0.12 to 1 to 0.03 to 1, which show that the company is credit worthy. Okay, remember the norm. We don't mention the norm nowadays, but please keep the norm at the back of your head. The norm is for a debt equity ratio. Where's my calculations for the debt equity ratio? For the debt equity ratio, the norm is, or we say low geared, 0.5 to 1 and lower. Okay, so that means that you are credit worthy, and low geared means that you run low on foreign capital. Okay, so it's credit worthy and low geared. I just want to mention what low geared means, just in my words. Run low on foreign capital. Okay, that is the meaning of low geared. It's low geared and it's credit worthy. So if you look at the debt equity ratio, of course we can take out a loan. And the second one, most important one, return on capital employed. Capital employed. Okay, we change it, so we say decreased from 23.4% to 19.5%, although, okay, although, I'm going to put it in, although return on capital decreased from 19.5%, it is still, okay, then you go there, 16%. And you compare it to your interest on loan. You compare it to your interest on loan. Is still higher than the 16% interest on loan. So you compare your return on capital employed with your interest on loan. This means that this is what we, basically this is our return, and from that return we must pay 16% to interest. And because it's more, you can take out a new loan. Okay, so they love to ask this question. Debt equity ratio, let me just make this a little bit bigger. To financial, if they talk about a loan, you always know if they ask you two financial indicators, you go to your debt equity ratio, you show that it decreased or increased, and you mention low geared credit worthy. This is very good. This is very, very good. Both of them are very good. So they run low on foreign capital. So at the end of the day, you can say they can take out a new loan. They can take out a new loan. They are more than welcome. You also take your return on capital employed, and you compare that with your interest rate, your 16% interest on loan. And if it's higher, it means that the return is 19.5%, and of the return, we must pay 16% to interest. Grade 12s, thank you very much. We are done with companies. That was the last lesson on companies. I really hope that you are okay with everything, the ledger accounts in the beginning, the income statement, the adjustments, the balance sheet without notes, the cash flow statement, and the analysis. Please work hard. You know, to exercise is the best thing that you can ever do. Thank you very much for listening to me. I will see you again next time, and have a good day. Thank you. Bye-bye.